Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about Oracle Financials Corporation, a very interesting share. Whether you should buy at these levels or not, let's discuss that. So, let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I talk about Oracle Financials, here's a small request that kindly support me on Patreon. Once you do that, it will help me grow the channel. It will help you also ask me questions on a daily basis. Once you get the $10 Patreon membership, you will have access to my portfolio as well as a watch list, and you will also get a chance to ask queries about markets and companies on a daily basis. One question on a day. You can also ask me separately about portfolio and stocks. You can directly email me, and through an email, I'll be ready to help you with the number of stocks. Now about Oracle Financials Corporation, established in 1990 and it is part of the Oracle Group, provides IT services in finance and NBFC. So the major focus is the financial companies globally, and the NBFC group rather than any consumption or anything else have 900 customers, and it is spread across the globe, not 10, 20 or 30 countries, but across 150 countries globally. Part of Oracle Inc, so you can very well understand as to what sort of company it is, with high pedigree, a very high dividend yield, and that is one reason why people would like to invest into Oracle Financial. Continuously it has given very good dividends over the last 15-20 years. Global leaders in software services to the financial sector. But at the moment, the sector as a whole is going through a lot of turmoil, and that's why the stock hasn't performed that well. The market cap of the company is around 22,000 crores. If you look at the financials of the company, then sales have grown by around a meager 2.7%. So, a normal sales growth when you consider, or you can say below par sales growth when you consider the NASCOM guidance for major IT firms, etc. Profit has declined by around 17% year on year when you looked at the December numbers. Absolutely zero debt, high promoter and institutional holding with only 6% free float. So that is also a big positive. But the biggest part or the best part about the company is that the return on equity is around 29% and operating profit margin is around 44%. Yes, in the financials and the consumer sector, we do find stocks with ROEs of northwards of 25%, but in the IT sectors, the ROE is more or less in the late teens or early 20s maximum. So 29% ROE is quite commendable. And look at the operating profit margin, that shows the operational efficiency of the company and the kind of efficiency that it produces while doing its business. It is just because of the sales that has been tepid and slight increase in expenses that the profits are coming lower at the moment. So the performance of the stocks, a big underperformance in the last 1 year. It hasn't done well, although over a 1 decade period, it has done remarkably well when you consider or compare it with other peers of its. Have remained stable before that for 5 years. So for 5 years, it did relatively fine when you consider how the other companies in the sector did, but it has been an underperformer over the last 1 year. Have been delivering very high margins, although profitability has not increased that much, but margins have. Results have been stable, and the last quarter has been, you can say, an aberration of sorts, because continuously it was growing at around 10-12% on a CAGR basis, but the last couple of quarters has been tepid, and the last quarter seen a degrowth. So that has not helped either. Slower global growth has really hurt the business. So they are not getting a lot of orders, and the order visibility is not that strong, and that's why the major, you can say, investors are staying away from the sector as a whole, not only Oracle Financials. And once the orders come back, there is more visibility, in the pipeline, and then you will see that more people would like to get into the stock. Currently the valuations are extremely attractive at 13-14 times. It should be trading at 18-20 times, so you have a clear cut 50% advantage on the valuation basis. But then again, I say that the business have to return, and there has to be prospects of the business doing really well over a period of 18 months, 24 months, and only then you can say the market would look at the company. Right now the valuations and everything else is fine, that they are looking very good, but we have to see visibility on the business front for major investors to get into the company. And once that happens, the stock will zoom very fast. So 4,000, 4,500 can happen in no time whatsoever, but then the visibility of the business has to be there. If you look at the technicals of the company, it has broken all support levels. So during that February March falls, so it did reasonably well for the last 1 year, although went down, but went down in not in a heap, but relatively went down 1 or 2%, half a percent here or there, and so it was in gyrations. But from February till March end, we have seen a sharp downtake on the stock, and that has led to the stock going down something like 40-50% from the highs that it made 3-4 years back. And then the recovery has taken place, and the recovery has meant that the stock is nearing its 200 DMA. The 200 DMA of Oracle Financial is around 2,700 rupees. Currently it is trading just below 2,600. What has happened is it has broken all support levels during that Feb March fall, and right now, technically speaking, it looks extremely weak. But then again, with the kind of business, the dividend yield, the kind of dividend that it gives, profitability that it has shown earlier, and if there is even a semblance of visibility that comes in from the order front, then the stock can easily move up 60-70% from these levels. And that is why I would say it is weak on the charts. There's no doubt about it that the stock looks weak on the chart. But if you have a good 8-10 year time frame, then this is one stock that you would like to get into, because over that period there will be occasions, probably 3-4-5 quarters, where things will get back to shape, and you will see numbers really kicking in, and the stock will certainly do much better than what sort of a number that would come into play. So one needs to be careful, but at the same time you need to get into such stocks which have been outperformers over 1-2 decades and have not been doing well because of the economic environment globally. So the major reason for the current fall in the stock and this industry as a whole is that more players or more of the countries, especially United States, is going for localization rather than globalization. So there are fears among investors that the run up for the IT industry that we have had from late 90s till today, that is going to be hampered because of you have seen the visa issues and other geopolitical issues that are taking place, apart from the financial issues that are taking place between countries. So things are right now pretty jittery when you consider the IT industry, and couple that with the kind of tepid growth that is projected by NASSCOM, and the tepid growth that these companies are showing. That is why these stocks are in doldrums. But it is not to say that the same scenario would happen all the time. So a deeper support is at 2,000. Probably you can buy in this range between 2,200 to 2,500. So, in my opinion, what has happened is things have looked extremely bleak, and it would not remain the same going forward. So, what you need to do is buy incrementally or as an SIP over a 8-10 months period. So, in my opinion, what needs to be done here is you need to buy incrementally over a 8-10 months period. And normally, I am not a proponent of SIP, but here in Oracle Financials, or in companies where you think that the recovery is going to take 2 3 years and you have a good 8 10 year time frame, then probably the wise thing to do is over the next 12 to 15 months just do an SIP. So if you want to buy suppose 3 lakh worth of shares over the next 15 months, then do it 20,000 a month, and like that, and probably you'll be fine. Over that 15-month period, you'll just write down that period of degrowth, and then you'll be primed for a move in the stock going forward. So in terms of the IT industry, I think the next couple of years could be tepid, could be tough, but even if you want to invest into it, the valuations are attractive. You do an SIP over a period of time and you'll have very good amount of shares while things get normalized and better going forward. The valuations are attractive, but again, it needs a technical strength. It needs fundamental strength with better orders, visibility, etc., and a better, you can say, news flow in front of it. So the IT industry needs to have positive news flow coming in from US, Europe, etc., in terms of growth, as well as the leaders of those countries probably agreeing to more people from India going there, or more people coming, more expats coming and working for the company, so there's more job growth in this field. So probably you can buy as an SIP, and if you want to really trade into it, buy it when it crosses around the 2800 levels. That would be best. Can be a good dividend play also. So over 10 20 years it will give you a lot of dividend, probably cover all your cost through dividend whatever you buy. Although I still believe that the consumption plays are much better off, so you need to look at pure consumption plays or consumer discretionary etc. When you consider this time frame, and have less than 5% exposure in such stocks. So this was my video on Oracle Financials. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.